In this final segment of this section, we'll be constructing a statement of cash flows from the balance sheet and the income statement. We'll be using what is called the indirect method. The indirect method is not preferable. The best method for creating a statement of cash flows is to be able to look at the individual accounts and changing accounts within the company, but in the public statements, those T accounts or those changes are not available. All we have is the accrued income statement and balance sheet from those public statements. The statement of cash flows is essentially all of the sources of cash minus all of the uses of cash. And the difference, if your statement of cash flow balances and is works and is congruent to the balance sheet and income statement, the difference between those two accounts is the change in cash and marketable securities. So if you're generating more cash than you're using, then your cash balance or change in cash and marketable securities should be going up. However, if you're using more cash than you're receiving, then that cash that you're using has got to come from somewhere, and it typically will come from that cash and marketable securities account. We break those cash flows up into three principal areas. Operating activities, those are the day-to-day operations or the normal activities that the company is in business to do and to perform. Investing activities, these are long-term investments in assets that are used by the company to generate operating cash flow. And then finally, financing activities. Financing activities are the sources of financing for both operations and investing activities. The combination of these three different types of activities is used in the statement of cash flow, and in aggregate, once again, the operating activities, the investing activities, and the financing activities added together will equal the change in cash and marketable securities. So this is what is called a sources and uses statement. And then we'll use the sources and uses statement to create what is called a statement of cash flows. In a statement of cash flows, we're interested in looking at what are the sources and what are the uses. And these questions help us answer, is the firm generating enough cash to fund projects? Is there excess cash? That can actually be a problem because cash doesn't create value for the shareholder, so it's possible to have too much cash. Are the firms meeting the stakeholder obligations using funds generated from operations, or are they meeting those obligations from, say, financing activities or selling assets? And then finally, is the firm meeting stakeholder obligations using funds generated from selling assets that may be needed for future operations? Your book outlines the following sources and uses, and we're going to use these rules as we go through and create a sources and uses statement, and then as we calculate the statement of cash flows. A source of cash is any increase in a liability or an equity account. So if I went to the bank and I borrowed $5,000, my liability would go up by $5,000, but I would be $5,000 richer. So that's a source of cash. So a source of cash is also a decrease in an asset account. If I sold my car, my assets would go down, but I would receive cash from those sales. So sources are increases in liabilities or decreases in assets. Uses are the flip side of those accounts. So when I decrease liabilities, so maybe I go back to the bank and I pay down that debt, my liability is now lower, but my cash is also lower. I've used cash to do that. Uses of cash are also an increase in an asset. So I go down to the car lot and I purchase a brand new car. I have a nice new shiny car, but I had to use cash in order to do it. So let's take a look at an example. This is an example that is found in your text. We will also be doing this process in class, and then we'll be doing it again in the project, in the assignment for this section. So Unitless Textiles has the following balance sheet from 2009 and 2008. And we can see that it's set up as a balance sheet should, where we have our total assets equals our total liabilities. We can see where we have two balance sheets, we can calculate the changes. So we can see that their changes from 2008 to 2009, their cash went down by $25. Their accounts receivable went up by $20. Their inventory went up by $70, and so on and so forth. So we asked two questions. First of all, is the account an asset or liability? And the second question is, did it increase or decrease? And from those two questions, we can determine whether it is a source or a use of cash. Now, I'm not going to go through each one of these counts individually. We're just going to move on after looking at the income statement to the sources and uses. So this is what is called a sources and uses statement. I've recreated the balance sheet from 2009 and the balance sheet from 2008. We've calculated the difference. So a cash and marketable securities account is an asset account. It goes down by $25. A decrease in an asset account is a source of cash. So we put that $25 on the left-hand side, indicating a source. Assets and receivables went up by $80. That's an asset, or excuse me, accounts receivable, that's an asset. A increase in an asset account is a use of cash. Inventory went up by $70. Increase in an asset account is a use of cash. All the way down through gross plant and equipment, which is also an asset account, increases by $80. It's a use of cash. Now we get to the liabilities, and we have an increase in our payables accounts. Increases in a liability is a source of cash. So we put the $15 difference here in the sources column. These represent all of the changes in our balance sheet from one period to next, and every item in our balance sheet is accounted for in this area. We next look at the income statement info. We find that their bottom line, they made $54 this year. We have to add back a depreciation expense of $50. $50 was an expense we took from our income statement, but it is a non-cash expense. But we did pay out a $29 dividend. A payment of a dividend is always a use of cash. If we've done this correctly, all of our sources should equal all of our uses. So we add up all the sources and all the uses, and we can see that every dollar is accounted for. Every dollar that came from a source has gone to a use. By creating that indirect sources and uses statement, we can now translate that down into a statement of cash flows. So these are all of the operating accounts, and if it's on the left-hand side, we put it there in that column as a positive. If it's on the right-hand side, we put it in our statement of cash flows as a negative. We can see that they generated $34 in cash from operations. That's a good thing. They invested $80 in cash for long-term investments, assets that are intended, at least in theory, to generate future cash flow. And then they made up the difference between the operating cash flows and the investing cash flows from the financing activities. So they borrowed another $5,000 in notes payable. They sold another $45,000 or $45 million in bonds, and they paid a $29 million dividend payment. When we add the $34 to the $80 or negative $80 to the $21, we see that they have a difference of $25. Where did that $25 come from? Well, as we stated before, it came from the difference between the cash at the beginning of the year to the cash at the end of the year. It came from their cash and marketable securities account. Now, what did we learn from this? Well, they generated $34 million from operations. That's a good thing. They spent $80 million on new fixed assets. Not necessarily a bad thing. They paid $29 million in dividends. That's sometimes required, and you'd expect that to happen. They issued $5 million in notes to make up for that difference. They increased their accruals by $5 million, borrowed another $45 million, sold marketable securities, and drew down the bank account by $25 million. They finished $25 million poorer. Is that bad? Well, we really don't know. It would be helpful if we saw kind of a trend or a long-term trend going on. But what can we conclude? We can conclude that if they were to continue this even one more year, they would be bankrupt. They would be illiquid, insolvent. They would not be solvent. Because at the end of the year, they only have $15 million left in their account. And if they repeated this process one more year, it would cost them $25 million, which means they would run out of cash. So can this financial policy continue indefinitely? Absolutely not. How many more years can it continue? Well, less than 1 year, because the $25 million that they would spend would wipe out the $15 million plus whatever they had. What do? Well, they need to change something. They need to generate more cash from operations. They need to slow down their investing activities. And then they need to think about how they can best finance that. One way might be to pay a lower dividend or maybe raise some more debt. But in any case, you can see that one more period would cause a severe problem for this company.